age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. And this morning we're going to be talking about tax strategies for 2014 and some of the changes that are coming about for 2014 with regard to tax rules, some of the tax legislation, and some of the things that are going to stay in place, some very important things such as capital gains tax rates, in particular for those in the 10 and 15% tax bracket. So we're going to get into some of these changes. One of the things I want you to also be thinking about is this is, of course, this is a time we're all thinking of, we're going to be getting our tax if you haven't already started receiving your tax forms in the mail, your 1099s and W-2s and getting ready to see your tax preparer to get your taxes done for this year. One of the things as you're gathering your tax things together to be thinking of is that when you're seeing a tax preparer, someone that you're going to be, that's going to help you as far as putting the right numbers in the right boxes so you stay out of that big box with the bars on the windows, right? One of the things to think about, though, is there's also something about tax strategies, tax planning, in other words. And this is a good time of year to start planning for next year. In other words, for this year, but for when tax time rolls around again next year. So this is a time to start putting strategies in place, start meeting with your tax planner to help you, in fact, in developing a tax plan for 2014, in addition to getting your taxes done for 2013. Now, some of these things that we're going to be looking at, for instance, are, this is a good time to look at your, as you're getting ready for the new tax, to finish out 2013, that is, and prepare to see your tax person. Do they do tax preparation only, or do they do tax planning? Do they meet with you other than just this time of year to get your taxes done, or do you maybe meet with them possibly at this time or at other times during the year for tax planning strategies, or at least talk to them on the phone about some of the things that are going on in your personal life or in your business life if that could impact your taxes and ways that you may minimize those taxes. Are you looking at your retirement accounts? If you're nearing retirement, are you starting to think in terms of what you're going to do with those retirement accounts when you retire? Are there ways that as you start taking income from those retirement accounts to minimize taxes? How dependent are you going to be on those tax accounts, those retirement accounts, when it comes time to start taking that money out? Are you going to need to take it out immediately when you retire, or maybe just a little bit at that time? Are you thinking maybe you don't need to take money out for some time, that it's going to mainly be a nest egg, a safety net, if you will? And if so, what about required minimum distributions? Have you thought of when those start to happen as you grow those accounts and you're forced by the IRS to start taking money out at age 70 and a half? What kind of tax planning do you have in place for that? Had you looked at, for instance, Roth conversions? Is that something that might make sense for you as a means to pay taxes now when they're lower rather than later when they're higher? We're going to be talking about all of that and more, not just what the new changes are going to be for this year, and how some of the things that are going to be carried over might be a good time to take advantage of them. For instance, maybe selling off some highly appreciated stocks or mutual funds, and or even potentially even with real estate, and yet pay zero tax. This can also be a good time maybe to do some conversions. All right, this might be another way to get, depending on your tax situation, again, to do some tax planning to see if this is a year in which you want to start maybe doing incrementally doing some Roth conversions to help minimize future taxes. I've talked about it in my book, and this is one of the things that I'm going to share with you again this morning. When I do seminars and public workshops, one of the things we talk about are what the tax rates are today. And I always start out asking people, is there anyone out there that thinks they're paying too little in taxes? Is there anyone who thinks, you know, my taxes really should be higher for all the things that I receive from my federal and state governments and such? Most people know. They feel that they would love to have to pay a lot less tax, in fact. And this is one of the areas when it comes to taxes to understand. Today, if you're making $50,000 a year as an example, you're in a 15% tax bracket. Now, when you compare that to, say, 20 years ago, you would have been in a 28% tax bracket. All right, even 15 years ago, in fact, you would have been in a 28% tax bracket, almost double what it is today. If you're in that 10% bracket, by the way, 15 years ago it didn't even exist. The lowest tax bracket was 15. So that alone, that's like a 50% decrease, or excuse me, about a 33% decrease in tax rate for those in the lower tax bracket. If you're in retirement, this can be very important because it also impacts your Social Security benefits, how much you make, and whether you're going to pay tax on those Social Security benefits. So we're going to share some strategies about how to minimize taxes, not only to keep you in the lower brackets, maybe to help take advantage of these lower capital gains rates, but also with regard to being able to minimize the tax effect possibly on your Social Security benefits as well. So, again, we're in a very low historically, tax rates are very low right now. If you go, as I mentioned, 15 years ago, it would have been 28%, almost double what it is today. And we can take that a step further. If you go back approximately 30 years ago, you would have been in a 49% tax bracket. So imagine having your taxes over 3 times as high as they are today. Now, could that happen again? This is one of the things we have to look at when we're talking about tax planning and Roth conversions. If we're at historically low tax rates, and let's take a look at let's read the tea leaves a little bit here, okay? We see what's going on with the Federal Reserve, all right? Even with Janet Yellen being appointed, it's going to be the successor for Ben Bernanke, we see still a continuation of that monetary easing and what effect that has with regard to inflation, of course. What else we're looking at is the effect as far as taxes. All right, one of the things that we're looking at right now is that we're still spending way more than we're taking in. Could inflation cause those make it even tougher to rein in that spending? One of the things, if we're spending $1 trillion more, all right, our federal government spending $1 trillion more each year than what we're taking in taxes and income taxes and other taxes, then that means we keep running up the deficit, the debt. All right, eventually that has to be paid back. How does that get paid back? And again, I talked about this in the introduction in the book. I've talked about it on the show before. A report by the Tax Foundation of America, a nonprofit organization that does such tax research. They found that if we tried to pay the deficits each year, just from income taxes alone, not counting other taxes, but just to make this point about how much this impacts our economy. If we try to pay it from income taxes alone, our income taxes, everybody's rates would triple. So that means your 10% bracket would be 30 approximately, your 15 you'd be back up in that 43, 44% range. So you can see that taxes could in fact go up dramatically in years to come. So again, is this the time to maybe pay taxes on certain accounts? All right, these are some of the things we're going to talk about. We're going to go to the phones, though, and this is Margie. Margie, welcome to the Retirement Report.
Thank you. I appreciate your program so much.
Thank you.
I recently sold some property that, I owned it jointly with someone else. Mm-hmm. And exactly what is the tax law on capital gains?
Okay.
I had been told by someone that, well, you don't do that anymore, but then the attorney involved in this said that had to do, I believe, with maybe a home that you may have lived in or had lived in.
Mm-hmm.
And
Yes.
that's what I wanted to ask you.
Okay, if it was a residence, if it's a place that you lived in for 2 of the last 5 years. So
Okay.
if you lived in it at one point and then you turned it into an investment or rental property and didn't live in it, but as long as you had lived in it 2 of the last 5 years, then you wouldn't, most likely would not have to pay gains, because you'd have, for a single person, a $250,000 exemption from those capital gains, for a couple, a $500,000 exemption on the gains. So that would cover most things. Now, if it's an investment property, on the other hand, and you're selling it, and now it would be potentially subject to capital gains, depending again on how much gain you've made and what tax bracket you're in. All right, so here's where, if you're, for instance, in a 15%, 10 or 15% tax bracket, you could potentially still have zero capital gains tax on those gains. Now, one thing to keep in mind is that the gain itself counts as income, so therefore it could push you into a higher bracket, and you might have to pay a 15 or even 20% capital gains tax in that event.
Okay.
So you're going to, in your situation, Margie, what you want to do you know how much of a gain you're going to make on this property?
It'll be quite a bit, but let me tell you that there's no house on it. It was just property.
Okay.
Quite a bit. Well, of course, on my part it wouldn't be, because it was owned jointly.
Okay, so your half of that, if it's going to be, let's say, $100,000 or more, then most likely you're going to end up paying a capital gains tax.
No, it was less than $24,000.
Okay. And is your income, are you single or married?
I'm single. I'm
Okay.
76. I'm elderly.
All right.
My Social Security is, I think, a little over $14,000. That's all the other income I have.
All right, so depending on what your depending on what your tax bracket is then, and it's 20, and how much you make otherwise, do you have a pension or just Social Security?
No, I just have my Social Security and that's it.
Most likely this is not going to impact you with regard to taxes then. The one catch, possibly, because you're going to be right on the edge of this, is, well, it could cause your Social Security benefits to be taxed.
Right.
But you shouldn't have to pay a tax on the capital gains. And this is one of the things that's going to get a little tricky. We're going to want to, what I would recommend to you is you would want to, do you have someone that does your taxes for you?
No, well, see, I haven't been required. My income, see, is so low, I haven't been required to.
Okay.
But I probably will have to this year, although
Right.
I know a little bit about taxes and how to figure, but I think this year I will have to get somebody to do it.
Yes. So one of the things that I would recommend to you, Dr. Friday will get you her information. She's going to appear on the show here shortly. And one of the things I'd recommend is you might get with her firm. Very inexpensive for her to do this type of return. It won't cost you much at all. And what she'll be able to do is she can pre-do your taxes, that is, so she can let you know what to plan for, if any, for that capital gains impact. All right, I'm more concerned. I don't think you're going to pay tax. Well, you're not going to pay tax on the capital gains. I'm not sure with regard to Social Security what impact that might have. So she'll be on shortly. We'll ask her that question and get you an answer.
I didn't know that the Social Security would have to be claimed as income.
Normally it's not, but there's something called a provisional income formula. And the way it works is you take half of your Social Security and you add it to certain other incomes. In this situation,
I know about that.
Okay. Well, in this situation, a capital gains income, even though it would otherwise not be taxable, may still count as income that causes your Social Security to be minimally taxed.
Okay.
All right, but I'll get you an answer. In fact, we're going to take a break. When we come back, I'm going to come back to that for you, okay? So stay tuned, and I'll get you an answer on that part, okay?
Thank you so very much. I appreciate it.
Thanks, Martha. You take care.
You too. Bye-bye.
All right, we're going to get into tax strategies, the tax changes and tax rule changes for 2014, and some strategies on how you can use these to your advantage as soon as we return here on the Retirement Report.